Welcome to the Good Endeavor Short-Term Rental Show. I'm your host, Mark McDaniel. Super excited to welcome Chris Seveney today, who leads Seveney Mortgage. Chris comes with over 25 years of real estate experience through developing, note lending. Chris is really known in the industry for his honesty and integrity and professionalism, and he's super passionate and tenacious in all the dealings that he does. And we were talking a little bit before the show, and I was getting to know Chris and what he does, and I'm super excited for this interview. Welcome to the show, Chris.
Mark, thanks for having me. How are you today?
I'm great, man. Thank you for joining.
No problem. I love talking real estate, so sometimes I get a little excited and passionate. I apologize in advance to everybody. But it's something I've been doing for many, many years, and I love it. So I enjoy talking about it as well.
Man, if I had Eeyore on the show, it wouldn't be very interesting. So I appreciate you being passionate. A lot of our listeners are used to short-term rental investing. And short-term rental investing, there's still diamonds in the rough out there. But unless you're a really good operator, it's going to be a lot harder to make money now just because cap rates are a lot lower. And so some folks are just looking for alternative investments. So Chris, tell us a little bit about what you do over at Seveney Investments.
Yeah, so we run a mortgage note fund. And what's a little different about our mortgage note fund is our primary line of business is not originating new loans for private deals or commercial deals. We buy loans from the secondary market. So let's say, Mark, you own a home in North Carolina, from, I'm just using this Bank of America. Over 50% of people's loans get sold, and we will buy those loans on the secondary market. And our primary focus actually is on the loans that are distressed or the loans that are non-performing is what we like to focus on.
So what is walk us through what a typical deal might look like. So a bank comes to you or you go to the bank and say, hey, give me a book of all your distressed properties and you pick which ones you want. Does it work that simply?
Pretty close. We usually don't deal directly with the banks. They usually will use like a merger and acquisition firm because they have all the contacts of all the people who will be interested in buying these assets. So what they'll do is they'll put it on an Excel spreadsheet of, okay, here's 100 assets that could be $40 million worth of assets. We see, we call them tapes, from one asset up to, I just got one that was $300 million of loans. So they can range in size. And, what's great about it is, unlike buying real estate where it's like first one in there gets to buy the asset, they put like a bid schedule together, like, okay, give me your bids by Friday. We'll take a week and then we'll let you know. And then you got 2 weeks to do due diligence. And after you do diligence, confirm your price. And so it's a process that is, nice in the fact that it's not like a super rush where I'm competing with you and I can't go look at the property that day. So a typical deal when we have one under agreement is, so I'll ask, before I do that, let me ask you a question.
Yeah.
You want to guess what the average delinquency rate or how many months behind a loan is that we buy? How many months?
So you're asking, okay, so if somebody's delinquent, what is the average? 150 days?
Okay. 3 years is our average delinquency. So I love your expression right now because, when people hear this, people think I miss a payment, I'm going to get thrown out of our house. And there's, depending on the state, it can take a very, certain states, it can be done in 4 or 5 months. Other states is 4 to 5 years. But these large institutions, think of a car manufacturer. If something goes wrong with a specific car on the manufacturing line, the assembly doesn't really know how to deal with it. They're just used to doing the same thing. It's very similar with mortgage loans because the banks are so used to it. All of a sudden, it's like, this one's not paying. They'll make phone calls and stuff, but they're not super aggressive, or they have 27 departments to kick it up to. And then the person stops, so they stick it in a file, and then they don't. So long story short, so I wanted to state that before, because that's an important component. So let's say you own $100,000 on your loan that is, 3 years behind. And let's say it was a $150,000 house that you put 20% down. So you put 30 grand down. So your mortgage was 120 and you owe 100 today. We would probably buy that loan for about $60,000. So anywhere from 40 to 70 cents on the dollar, but usually it's around 60. So we'd buy it for 60,000. They still owe us 100. And I'm just going to use simple numbers of payments, $1,000 per month. And they're 3 years behind. So it's $36,000 behind. We may go to you and say, hey, Mark, we're trying to work something out to keep you in your home. Can you give me $10,000 down, not 36, but just $10,000 down, and then start making, and if you do that and then if you make 12 months of $1,000 payments, I will push that money back to the back end of the loan, the other $24,000 that you owe. And, a lot of borrowers will be basically like, work with you in some way. But let's use that example. If I get $10,000 down, and then I get an extra $12,000 in that first year, I just got $22,000 on a $60,000 investment. And then, I can push that to the end because I'm still getting it. But the interesting thing is after like 12, 18 months, I can turn around and now sell that loan back onto the market, and I might be able to sell it for 80 or 90 cents on the dollar. And then when you think about your mortgage payment of principal versus interest, most of your payment's interest, so the principals really hasn't come down that much. So we get that kicker on the end. So my business partner, Lauren, likes to describe it as instead of fixing and flipping properties, we're fixing and flipping the loan with the borrower. We're trying to renovate the borrower to get them again on a payment plan. Yeah. And basically then turn around once they're, I'll call it fixed, then turn around and sell it. And then the other component to it is if somebody says, well, what if they stop paying? Now, our average loan is probably like 9 years old. What was a house worth 9 years ago versus today? That $150,000 house is probably worth $225 today. They owe 100. We have 60 into it, so we have very low coverage. And if they don't, we could then go to legal route, which would end up possibly in a foreclosure, which then we would just get paid off because the house would get an investor would pay more than $100,000 for a $200,000 house.
Mm-hmm. I think of banks. So I've dealt a lot with banks, and I think you're right. I'm not sure how small banks, like regional banks, think about it, but they're probably similar to large banks and how they process payments and whatnot. But they don't want to own real estate. They want to lend on real estate. So is there any part of your business that takes a non-performing loan, turns it into a performing loan, and then for whatever reason, the borrower can't make payments again, and you have to go with the eviction route and foreclosure route? Is there any part of your business that takes the house, fixes it up, and puts it back on the market, or do you just try to wholesale it or sell the loan, period?
Usually we will just try and sell it to an investor as is. Yeah. I spent 20 years in construction, and trying to manage construction when it's across the street from you is tough. Trying to do it we've invested in over 40 states. I've physically, I think, only probably driven by out of 600 plus loans, probably like 2 or 3 of the properties that we've owned personally. So knowing what I know, trying to renovate from afar is not fun, and it probably won't really get us that big bump we want. We might trash out the property or clean it out or do some minor stuff to the property, but like a full-blown rehab, we'll let the experts in the area and work with them. And we can also be creative with them where it's like, hey, look, we'll sell or finance it to you, and you don't have to pay cash for it. And then, might be able to get a little better price and then get paid off 6 months later. So that's what's great about the bank. You're always in control, where we have so many exits that we can do. So that's why, again, we don't want to own real estate. I've owned plenty of real estate in my life. That's why I do notes now, because I got tired of owning real estate.
It's a lot less headache and a lot less moving parts. So if I'm Joe investor and I've been investing in real estate, and I'm just like, man, this picture that everybody's painted this to be, it can be great. Like, it can be really good, but now we're kind of going into a high interest rate environment, a little tougher environment financially. I'm looking for maybe a more passive way. What is what does the day-to-day or month-to-month or year-to-year look like if I'm an investor with you guys?
Yeah, so we run two funds, a Regulation A plus and a Regulation D, 506C. So the Regulation A, which is open to anybody, accredited and non-accredited, it's a $5,000 minimum investment. And, for example, today, we're towards the end of a month. If somebody invested today, they would start accruing their dividend on the first of the next month, and the first of the following month, they get they get their first distribution. And we send out, quarterly reports to the investors. We have an internal investor relations team that's, based here in the United States. So you can speak to somebody if you need to, get access to your account. It's essentially like buying shares of a public company, but of course we're not public, we are private. And for those, that enjoy, case studies, we have a podcast, we have a YouTube channel, we do lots of case studies, we send out deals of the week. So we like to over communicate with our investors because we want to educate our investors, because I've always found more educated the investor, the better the relationship.
That's right. And the trust level goes through the roof. And so if I'm investing in the fund, obviously this is a myriad of pieces of real estate. I'm not just investing into one house with you, right?
Yep, correct. So, you would have preferred equity with the shares, and we don't have debt because we are the bank. You think of other types of syndications where they raise 40% of money and get 60% leverage from a lender. So on that capital stack, of course, it goes to debt. Then you might have some equity. Now we don't have that debt, so our investors are preferred equity. So they're first in the food chain on the capital stack.
Okay. So that was the appealing part of short-term rentals, is that somebody could come in and they could invest in a property, and they thought. So many folks think they have a full-time job, and they thought that they could get active participation, which requires a lot of rules in order to get a tax advantage. By investing in a fund in notes, you equated it to kind of like a shares of a company to a stock. Are there any tax advantages to that, or is it kind of taxed as capital gains?
So typically, and this is something to always ask, no matter what type of fund you invest in, is to understand that tax structure, because everybody looks at the nice numbers that are on the PPM or in that marketing brochure, but that's the gross. What is your nets? And the way we structured it, which is different, and I can thank my wife for this, because we used to get so many K1s and it would take forever to get our taxes done. Finally, she convinced me, which we did this as a C corporation, so people get a 1099 dividend. So just like if you owned Apple shares or some other shares, the end of January, you just get a dividend, which is then should be a qualified dividend. I can't provide tax advice. That is taxed at a much lower rate than a lot of other note funds, because typically you're getting interest income, and interest income is actually taxed at your ordinary income rate. So that is one area that we try to educate a lot of our investors on, or potential investors, because they might look at and say, well, this person's an extra point higher than yours. I'm like, well, yeah, but you're paying 37% with them, you're only paying 20% with me. So actually at the end of the day, I'm like a point higher. So, do you want me to drop it a point so we're even? Joking. But that's something to absolutely make sure you pay attention to, because also, K1s, they cost more to have your accountant do them and everything, where the 1099 divs are just like simple.
Yeah. That's nice. I really like that. I don't think a lot of folks do it that way.
It's actually, we're paying for it as a company.
Yeah.
But it's kind of, how we structured everything overall within, the operations of the company. But this is also some of the things that, if you are looking to invest passively, some of the questions that you need to ask, because, people a lot of times just ask like, oh, what are you investing in? What's the asset? What's this? And, they forget to ask a lot of those follow-on leading questions of, okay, like, what is reporting? When do I get my K1s? How many K1s do you get on time? You issue on time in your history versus what do I have? Because that can lead to, a lot of frustration. And back in the day with some of my other funds where I had K1s, especially today with accountants, in demand, stuff gets delayed, and it's not good if you have to delay documents to your investors.
You're absolutely right. Just went through that. I should have asked you this at the beginning of the conversation. How long have you guys been doing this?
So I've been doing notes since 2016. I started in real estate in 97. Graduated college in 97, 15 years for a large commercial general contractor, building really cool projects, 300 unit apartment buildings, courthouses, office retail, you name it, I built it. Then I spent 10 years working for a developer. After I started working for a developer, he asked me, hey, what do you have in your personal portfolio? And I'm like, oh, nothing. I've been working. And he laughed at me. He goes, you got to start owning real estate. So in 2014, I started buying more local real estate here in the DC area. But my wife and I, with 2 little kids, just couldn't handle it. It was just too much with the W-2s. So my wife's like, we can't do this anymore. So I thank my wife for getting me in notes, because then I'm like, okay, what else can I do? I stumbled upon note investing, which I didn't even know existed. I was kind of upset. I knew private lending, but I didn't know you could do the mortgage notes on the secondary market. So I found out about it in 2016 and dove straight in. So the last 7 years went from 0 to 600 plus loans. I'm on my 5th or 6th fund. I always forget. It's been going well, to say the least.
Did you start out creating funds, or were you kind of doing it on your own and then just developed over time?
Yeah, I'm a conservative type, so I won't take people's money until I absolutely know what I'm doing. So I started with some of my own retirement account money, and I started out buying 4 notes, and then got the hang of it, and then started buying more. And then what I realized was, I go to these conferences, and I'm sure every aspect of real estate, this is the case. You go to a conference, and 95% of the people there I call window shoppers. They're there basically thinking they're going to do it, but never end up doing it or find it's too hard. So I started reaching out to people at conferences and said, hey, look, if you find it too difficult, I'll manage and you fund the deal and we'll split the profits. So I started doing JV deals. And once I got to I had 50 JV deals going on, which every JV deal is like its own company, essentially, because I have to keep separate books. Then I realized, okay, let's go to the fund model. So in 2018, I started putting together several funds that they were small dollar. They were, few million bucks, that I was testing, different return profiles, different language, just wanted to test everything, because what I didn't want to do, and it was really for me to make sure, okay, can I still make money in a fund structure? I didn't want to give all the upside to all the investors and me do this for 2 years making nothing. So kind of structured to understand, and also understand the investor avatar. What do the investors want? What do they like? Because note investing funds are very different investor profile than somebody who's investing in, call it cryptocurrency as an example, because they're very high risk compared to most people in note funds are, more conservative on the risk.
Do you find that a lot of note investors have a similar path that you had? Like, they were heavy in real estate and just wanted less of the burden, and they kind of came out of it?
It's the same thing. I joke, when I went from construction to development, they always said you went over to the dark side working for a developer. I view note investing as the dark side, because people, when they get tired of owning all this real estate and tired of dealing with, we say tenants, toilets, and termites, and that 2 a.m. call that the roof leak or somebody broke something, even if you have a property management, they still text you too. We don't have to deal with that. So now let's not say I still don't own real estate. Of course, I still own some real estate, for many different purposes. I, always recommend a diverse portfolio, but that's now not my primary course of business. And, we have other headaches, of course, we deal with, but, I find it not as intrusive as actually owning the real estate.
Wow. So, you can go to the bank right now and you can get 5% on your savings. And so it's easy, it's passive. If I were to invest with you guys, what would life kind of look like with that? Obviously, the you can't be entirely liquid the entire time, but in exchange for that, maybe you get a little better return. Is that right?
Yeah, it's 8 to 10% is where people where the dividends fall depending on the investment amount. And that's it's always challenging when you can go get 5% at the bank, and people look at these real estate deals and they're thinking, oh, interest rates went up, so you should be paying more of a return. And it's actually the opposite of within real estate in most markets now. As the cost of everything goes up, that actually diminishes returns. Multifamily, I'm just going to pick on multifamily. I love multifamily. Multifamily returns 3 years ago at a 2.5% mortgage is very different than it is today at a 7% mortgage. A lot of the numbers don't even work today. So when you can get that cost of capital, at a lower premium. And that's, I think investors just have to realize that, and, also look at, trying to diversify that portfolio.
Yeah. Yeah. So minimum investments, 5K. What's your typical investor look like? I mean, 5K to the sky's the limit, or is there a limit?
The sky's the limit. So we started with retail investors. We have about 500 investors. The average investment's right around 40,000. A lot of people put 25 in because that's where you get the first group of bonus shares, which gets you a little bit over 9% return from that standpoint. So it's about 40,000. We started now working with some broker dealers and get some institutional money. So that's a lengthy process, and we started working that, but that's going positive at this point in time. But from that retail side of things, like I said, we're a little over 500 investors, and the average is right around 40,000.
So you mentioned something, and I didn't maybe mention this earlier. I didn't pick up on it, but at a certain level, which it sounds like it's 25,000, you get a little bit of a preferred return.
Yep. Yeah. So if you invest 5,000, you get 8%. If you invest 25,000, so it's $10 a share. So you have 2,500 shares, but at 25,000, we give you an extra 100 shares. So basically, your share price comes down, if you want to look at it that way. So you would now be earning that interest on 2,600 shares. And then when you cash out, it's a 4-year lockup. You can keep going if you want, or you can cash out. But at 4-year mark, you can cash in, and then you get 26,000. You get that extra $1,000 bump at the end as well.
Is there a level above 25,000?
Yeah, it's 25. I think 50. Then I think it goes up to 100, and then 250.
Okay.
So it's tiered, and all of that's on our website that you can have. So the more you invest, the better. Little better perks we provide.
That's great. And so that's the total 4-year kind of promise. Not promise. Nothing's ever promised, but that's the 4-year anticipated return. And then if I'm like my monthly dividend, what is that? Is that part of the total calculation on the return? I assume.
Yeah. So we don't do the DRIP, which is direct reinvestment. So if you invest, let's just say $10,000, you'll get, let's see, roughly, your check would be like, 60 something bucks a month or whatever. 8% is $800 a year. So you just get that every month, back to you. And then, like I said, so you get that for, we haven't missed a distribution since last July. So, you get your distribution payment, and then at the end, basically anticipation, of course, would be to get your full, your capital back at that point in time. And it's nice because after that time, you can leave it, if you want, or pull it. And, so we might be waiting on another investment. So, you can leave it in there at that point in time. So we're open-ended from that standpoint. So we're not shutting it down where we're going to be, stuff saying, okay, here you go back with the funds at that point in time.
Yeah. And I guess that makes sense for you guys, because the more you invest, the fewer investors you administrate. And so it makes sense to kind of get a little more incentive there.
And with technology today, whether it's 10 investors or 10,000, the technology's there to make it pretty simple today. Within the fund management, with the software that's out there of, basically, our investment process is pretty simple. It's all done online, where it's through a broker-dealer website where you put in your information. Then you can sign your subscription agreement. You can select kind of the payment right then and there, and then money and everything goes to an escrow agent. So right now we're using an escrow agent, so the money goes into them to make sure all the documents. One thing that is a little different that we hadn't done in the past, that we do now, is the whole AML, KYC, anti-money laundering, know your customer. So we run that on every person, which, interesting story, we did have somebody who wanted to invest $5 million, but they're like, can I invest it outside of the fund? And we're like, well, no, you have to invest it through the fund. And he was back and forth and stuff. So me being the internet sleuth I think I am, went and Googled this guy, and this guy had spent I think it was 15 years in prison for being a drug runner. So I'm like, yeah, probably should not, which, I mean, and that's the stuff like that whole AML KYC, they'll pick up on that and they will reject that person. So that's why it goes to escrow. So if they fail that, then escrow will just basically be like, hey, you didn't pass, here's your money back.
Yeah, that's interesting, man. I've got stories like that in the construction business in Eastern Tennessee of contractors I've gotten into bed with or did business with. I found out one was on America's Most Wanted, and another one had done some white collar crimes. And so, yeah, it's interesting in this business.
It's interesting, some of the story. And that's we like to share case studies, because one of the things we like to share is lenders sometimes have that bad rap of being the big bad bank and coming in just foreclosing on people. As we mentioned earlier, I don't want their house, and we tell them we don't want your house, but you still need to play ball. We probably only foreclose on about 10% of our assets. And usually that's because the person's either deceased or they don't actually want the property. But we've got one or two right now, they filed bankruptcy 5 times in the last 2 years that they just keep filing and just stalling. One of them actually, while they're in bankruptcy, and I don't know how they were able to do this, bought a Range Rover and a Mercedes. And, they haven't paid in 6 years. And
hard money loans.
So who knows, but it's, people like that, again, it's up to you whether you feel sympathy for somebody who hasn't paid in 6 years, but, just went and bought a Range Rover and a Mercedes, people voice their own opinion. But, there's we talked earlier before we started, any business, there's good ideas and there's people who do it well and people who, know how to game the system.
I mean, I guess the good news of that, that was one of the questions I was going to ask, what's the worst case scenario in doing business this way? But the good news is you're buying it from a capital standpoint at such a heavy discount. You're buying it 50 cents on the dollar, 60 cents on the dollar. And so you've allowed yourself enough margin in these deals so where you're not stressed about them missing a payment, and you're trying to work with these folks to allow them to make payments.
Yeah, and to give you an idea, our entire portfolio, and these are just going to be rough numbers. Now, we've got roughly 17 million in cash out the door. The balance on the loans are 27 million, and the property values of all the assets is 55 million.
Oh, wow.
Look at from a loan to value. The loan to value is under 50%, and investment to value is even, it's at 35%. And what happened with, in 2008, with a lot of people, they had those second mortgages that, basically property values dropped. So those mortgages became underwater, or even their primary mortgage became underwater. And that devalued the loans significantly, because you owe $100,000, your property's only worth 50. The bank's only getting what the property's worth. And, you can't get water from a rock if the person doesn't have anything else. So
that's right.
That's where, you got to be careful and make sure the equity is in these properties, which is hard because, I can't go knock on your door, Mark, and say, hey, I'm buying your loan that you haven't paid for in 3 years. Let me see the inside of the property.
That's right.
We send people by to look on the outside and do inspections on the outside, but, it's still we have to do a good evaluation. Man, this is good. I know we've kind of bobbed and weaved through the conversation, so I appreciate you being patient and answering all my inquisitive questions. Man, if somebody wants to get in touch with you or become a note investor with your firm,
what's the best way to reach out to you?
Yeah, they can email me, Chris, my first name, CHRIS, at the number 7, the letter E, investments.com. Now, our website is 7einvestments.com. You can find out more information about our fund. People looking for more education, we do run a membership group that meets bi-weekly. That is more of a roll up your sleeves and want to get something done type of education, where we walk through a lot of things with investors. And I try and keep that limited to under 20 people within the group. So, because I don't want 1,000 people that I'm trying to mentor, train. I don't have time for it. I do it more for, because I love the business. But yeah, go to a website, and, if you're interested in investing, or email me and set up a call with, either Katie, Tony, or Lauren, who work for us on the investor relations side. And they're happy to discuss all the details, answer questions, whether you're looking to invest with a self-directed IRA, however it is you're interested.
This is great. It makes me rethink some of my strategy kind of moving forward around some passive income. So thank you for this. And folks, if you want to invest with Chris, reach out, go to 7e.com. And I think that's it, man. I really appreciate it.
Mark, thanks for having me today. Greatly enjoyed
You're welcome.
speaking with you.